Welcome to episode 5 of the SaaS Report. Hey everybody, I'm Matt Aird, host of the SaaS Report and founder at Sales Science. In today's episode, we're going to be looking at Q2 results from Sprout Social, Zscaler, Semrush, and WalkMe. We're also going to be taking a look at the Smartsheet acquisition by Vista Equity Partners and Blackstone. And we'll take a look at the opportunity that exists at the moment to acquire private SaaS companies that have taken on way too much venture funding and find themselves in a bit of a tricky situation. First off, let's take a look at Q2 numbers from Sprout Social. So Sprout Social is a social media management platform. So they help organizations to create, schedule, and then monitor their social content. They're at $393 million in ARR. So at the smaller end for the public SaaS companies that we track. They grew ARR 20% year over year and added 10 million in net new ARR for Q2. They spent $46 million on sales and marketing in order to generate that growth. So that gave them a CAC payback of 66 months and a magic number of 0.23. An average customer pays them just over $1,000 a month at the moment. So we're talking about fairly small deal sizes for Sprout Social. They've got a rule of 40 of 22% due to their fairly low free cash flow margins, a rule of X of 42. They've still got negative operating margins, so they lost $2 million for the quarter, which puts them at negative 16.5% from an operating margin standpoint. So in a bit of a tricky situation here at the moment, not growing particularly fast, especially for a company that is on the lower end of ARR for a public company. Still not generating a lot of cash, so cash flow margins are still low and still running fairly sizable operating losses. So a little bit of work to do here for Sprout Social to get them into some of the kind of gold standard metrics that we'd look at. Next up, we've got Zscaler. So Zscaler added $159 million in net new ARR in Q2. So that represented 30% ARR growth year over year. They spent $294 million on sales and marketing to achieve that. And that gives them a CAC payback of 25 months and a magic number of 0.6. So really efficient go-to-market numbers for Zscaler, right? Especially when you take into consideration they're at 2.37 billion in ARR. Right, so pretty large ARR base, still finding a way to grow fairly efficiently from a go-to-market standpoint. They're generating 23% free cash flow margins as well, which is really strong. So they've got a rule of 40 of 53 and a rule of X of 83, which puts them right at the gold standard. So we looked at a couple of weeks ago, a really good number for rule of X is 70, and they're at 83 on that metric. They also gave us a look at total customer base. So they reported that they've got 8,650 total customers as of Q2 24, paying them an average of $274,000 each. And that's up from an average contract value of $236,000 in Q2 of last year. So really good job growing ACV there by them. They've still got an operating loss of 27 million, but as a percentage, that's only a negative 1% operating margin. So basically break even at this point. So really solid metrics, right? So you've got strong ARR growth, you've got good go-to-market efficiency, you've basically break even from an operating margin standpoint, so performing really well. And they're being rewarded pretty fairly, I think, by the public market, so they're valued at 11 times ARR right now. Next up, we've got Semrush. So all of the marketers out there will be familiar with Semrush. Semrush is a keywords planning and analytics tool. So a lot of people use it for kind of optimizing and planning SEO campaigns. Semrush went public in March of 2021 when they were only at 159 million in ARR, right? So they've since grown that to 363 million, and growth in Q2 of this year was 22%. So they added 20 million in net new ARR in the quarter, spending $35 million on sales and marketing in order to do that. So that gives them CAC payback of 23.7 months and a magic number of 0.6. So pretty good go-to-market efficiency there. Both of those metrics have improved significantly compared to Q2 of last year. So magic numbers up about 50% and CAC payback is down about 30%. So a really good job streamlining that. Q2 as well was their 4th consecutive quarter of positive operating margin. So still growing strongly, bringing the business into positive operating margins, improving go-to-market efficiency. Really good story for them at the moment. They've got a free cash flow margin of 8%, rule of 40 of 30, rule of X of 52. And I think trading fairly cheaply for a company that's still fairly early in the journey. They're only trading at 6.2 times ARR right now. So a little bit undervalued, I think, based on the metrics currently. And finally today we've got WalkMe. So WalkMe released Q2 numbers. This might be the last quarterly report we get from WalkMe. They've entered into an agreement to be acquired by SAP. The acquisition valued the company at $1.5 billion, or about 5.7 times second quarter ARR. So WalkMe is this digital adoption platform. So basically what they're designed to do is to help the employees of large organizations to utilize the software within the business more efficiently. So it helps to guide you through the use of a new software program. It helps the IT department to see where people are getting stuck, that kind of thing. So WalkMe added $5 million in net new ARR in Q2. And they spent $40 million on sales and marketing in order to achieve that. So that gives them a CAC payback of 154 months, which is horrendous. A magic number of just 0.9 again. So basically what that means is they're adding 9 cents in net new ARR for every dollar that they're spending on sales and marketing. Also had a big operating loss, so lost $20 million in the quarter. That's a negative 30% operating margin. So we can see from this that the acquisition of WalkMe by SAP is a fairly strategic one. The product fits in nicely with SAP's other product offerings. This certainly isn't an acquisition based on the the business fundamentals of WalkMe and the fact that they're setting the world on fire in terms of growth and go-to-market efficiency. So yeah, that might be, as I said, the last quarterly report we get from them, but probably not the worst thing. Pretty terrible metrics there in Q2 for WalkMe. In last week's episode, I talked about the concept of investors being able to purchase private SaaS companies where growth had stalled and the founders and the investors may be underwater slightly just based on the fact that the company's raised too much money, growth has stalled, and they're probably going to be in a position where they're not going to grow into their valuation, right? So listen to a podcast recently where Jeremy Jaffon was a guest on Invest Like the Best. Now, Jeremy is one of the co-founders of a private equity firm called Tiny. And Jeremy walked us through this concept of identifying private technology businesses where the incentives between the founder and the VC were now misaligned because the company that had received a bunch of funding to go and grow into this massive valuation wasn't going to be able to hit those milestones for whatever reason, right? Now, if you think about the current situation that we find ourselves in, there are probably a lot of companies in this situation, right? 24, 36 months ago, valuations for private technology companies were absolutely through the roof, right? You had private stage companies at very low millions in ARR, raising at up to 100 times ARR in terms of valuations. And so basically what that's done is that's put a bunch of private companies into a position where they're not going to be able to grow into that valuation, right? The demand from B2B buyers for new software has fallen off a cliff, and these private companies are finding it really hard to generate ARR growth. If they can't generate the ARR growth, then they're not able to raise the next funding round, which puts them in a tricky situation. So Jeremy was talking about the situation, and to understand why this problem exists, we need to understand this concept of liquidation preferences. So a liquidation preference is basically a right that an investor has when they invest money in a startup that says that I'm going to get my money back. So let's say if I invest $20 million into your startup, the first money that comes as a result of a liquidation event, whether that be a sale to another company or it may be an IPO, for example, the first money that comes out of that transaction, the first 20 million, if I invested 20 million, comes back to me, right? And then the rest of the money can be divided up amongst the other shareholders. And so what happens in these situations is that VCs will often have a 1x liquidation preference. They could have a 2x liquidation preference, or sometimes even, based on reports, up to a 3x liquidation preference if they're investing in later stages, or the investor has a lot of leverage over the founder, let's say. And so that creates a situation where the founders can find themselves in a position where the equity that they own in the business isn't worth anything, right? Because they've raised so much money and the valuation that they need to grow into in order to realize any monetary gain, the gap between those two things is too great, right? And so you've got a situation where a private company, they've raised a bunch of money. They're planning to spend that money over the next 12 to 18 months in order to generate growth. And for whatever reason, that growth doesn't materialize. And so now they're in a position where A, they either need to go and raise another round, which would likely be a down round, or they shut the company down. The problem with raising a down round is that the founders will get absolutely drowned in the pref stack, right? Which means that it's going to make it even harder for them to make money on an eventual exit, right? Because they're going to get another round of capital into business, which gives another set of investors liquidation preferences, which means they're even further down the cap table in terms of realizing any gain from an eventual sale, right? So they don't want to raise a down round. On the other side, you've got, the existing investors or the VCs are looking at this company and they're saying, look, this company's never going to make any money. And VCs are in the outlier business, right? They're typically got a portfolio of companies that they've invested in, and they only need one or two of those companies to have an outsized result in order to generate good returns for the fund. So what VCs really don't want to do is spend time on the companies that have no chance of generating a meaningful outcome for them, right? And so you've kind of got this situation where, founders don't want to continue because there's no upside for them, and the VCs don't want to continue because there's no chance that this company generates a return for the fund, right? But the situation is that, founders often don't want to go back and say, hey, we've failed, or we can't make this work. And VCs don't want to be put in a position where they tell the founders to shut down the company because that looks bad, right? If news gets out that a VC, told us to shut down the company because it wasn't working, right? That's not a good look for the VC. They want to be seen as being kind of like founder friendly. And so what Jeremy talks about is there's this real opportunity that exists to be able to go in and recapitalize the business or purchase the business outright from these two parties who have kind of no incentive to continue operating it, right? So typically these assets are actually, if they were owned by a single individual, would be great assets, right? You could have a SaaS business that has, let's call it $5 million in ARR, that has positive net revenue retention. And the only thing wrong with it is that it was valued at, $150 million, right, 12 months ago. And so it's still burning a bunch of cash. It needs some funding, or it needs some money to be able to get through the next 12 or 24 months, or it needs to significantly cut its burn, which means laying off a bunch of people in order to survive. And neither of the existing owners, the VC or the founders, have any incentive to follow either of those two tracks, right? And so as a private investor, you could come in, purchase this business, which is a great asset. The only thing wrong with it is the capital structure, right? And now you own an asset outright that's, generating $5 million in ARR, has positive net revenue retention, right? And could grow 15 to 20% a year with the right attention and the right focus. So as I was researching this idea, I found a really good follow on X. It's at lower left PE. I'll drop a link to his Twitter in the show notes. But this guy is running a fund basically at the moment where he's executing this exact strategy. So he's going to find founders that are drowned in the pref stack and VCs that are owning companies that are never going to materialize. And he's buying these companies and rolling them up into a fund. So if this idea is interesting, I'll share a link to this guy's Twitter. You can check his stuff out. It's really cool. The other thing to consider here is if you're a founder and you're planning to raise VC, you're either on that path or you want to get on that path, right? One of the things to really consider is like, how big do you go, right? Because if you're chasing the moonshot here and you're raising a lot of money and you're doing so at a big valuation, just be aware that really in that situation, the only way you get economic upside is to hit those targets. There typically isn't a scenario where you can kind of like pare the business back to a cash flowing business in which you're going to make any money in that situation. So I think it's just key to like understand the game that you're playing. If you're going big, great, go big, but you need to understand that there really is kind of like only one outcome when you follow that path. Also had news this week, so this will be last week when you see this, that Smartsheet is being acquired. So we spent a bunch of time a couple of weeks ago looking at Smartsheet's metrics, right? They're obviously in this project management, workflow management space in the battle with other public companies like Asana and Monday. And they're being bought or taken private. So combination of Blackstone and Vista Equity Partners, they're paying $8.4 billion in cash to take Smartsheet private. That values them at just under 8 times ARR based on Q2 numbers. And the interesting variable here is the Vista Equity Partners of this transaction. So Vista is a technology, or specifically a software private equity firm, right? So they go out and they buy software companies with the goal of either growing them or making them more profitable, and then typically look to resell them a few years later. They've got an exceptional track record in this space. So in 2016, they bought Marketo for $1.75 billion and sold it just 2 years later for $4.75 billion to Adobe. They'll likely be leading the charge post-acquisition. So it's likely that Blackstone's providing some of the capital, but Vista will likely run the operations once Smartsheet is acquired. And they're well known for their very like formulaic, almost factory-like approach to managing SaaS businesses. So they talk about the fact that they've got over 100 what they call best practice plays that they put in place in these companies that they acquire. And that covers everything from, how do you hire and onboard people? What are the sales metrics that we track? How do we run customer success? How do we interview? How do we promote? How do we run performance analysis across people? I tried to do some digging to see if I could find any specific details around these things, but they've done a good job at keeping this confidential. After all, this is really their secret sauce. This is what they use to generate kind of the outsized returns that they generate when they acquire these software businesses. It's really interesting. The founder, Robert F. Smith, is a guy that has a chemical engineering background, right? So you think of engineers, you think of breaking problems down into their component parts, being very formulaic on the way that they try to solve problems and build things. He's the founder of Vista, and you can see, well, the way that at least they talk about the way that they operate these businesses is very engineering-like in nature. So Vista's been really active in the SaaS space in recent years. So they've in the go-to-market space in particular, they purchased companies like Drift, Pipedrive, and SalesLoft. So SalesLoft, obviously the competitor to Outreach. Vista has historically had much more of a focus on companies that sell to the enterprise, right? So in an interview I watched this week, Robert F. Smith talked about the fact that for businesses, the best ROI that you can get typically is by purchasing a new piece of software, right? So business software generates on average about a 600% return on investment. And so one of the reasons likely that he was attracted to Smartsheet was the fact that they've had a lot of success penetrating the enterprise space. So they boast about 90% of the Fortune 500 as customers, right? They're much more saturated, kind of like upmarket compared to the competitors that we reviewed them against last week. So Monday and Asana, who are both still more dominant kind of at the, SME or mid-market space. Smartsheet's had a lot of success in gaining a foothold into the enterprise segment. That's likely one of the reasons that Vista was attracted to them. Now, this may be the start of a lot more of these deals over the next few quarters. We've got a situation now where public SaaS company multiples are at the lowest rate that they've been at since 2016, right? So you've got this situation where multiples are down, which means these companies are cheaper to buy. Growth rates lower. Free cash flow margin rates are higher, which is helpful to an acquirer, right? If a company's generating more cash, that helps us to pay back the debt that we're going to use to acquire that business. And we've also got in the macro environment, right, interest rates looking like they're starting to come down. So we've had a 50 basis point drop. Chances are that we probably get more interest rate drops over the next few quarters, which means that the money that these private equity firms borrow in order to purchase these companies is going to come at lower rates. All right, so you put all of those things together and we could have a situation in which private equity gets very active in terms of buying these public enterprise SaaS businesses. A couple of candidates that I think may be targets for them. So number one is Box. Box is a company that has had really tough time growing over the last 4 or 5 quarters, but has really strong free cash flow margins, right? They are very heavily skewed towards the enterprise, right? So the majority of their customers are enterprise. Think of them as like Dropbox, but for large businesses. I think Box could be someone that gets taken private over the next few quarters. So obviously we'll keep an eye on this. If there are any other announcements, we'll be sure to cover them here on the pod. Salesforce and HubSpot both held their annual customer conferences a couple of weeks ago. And the theme of the keynotes at both events was the rise of AI agents. So we've talked about this a little bit on previous episodes, but AI agents is the idea of having, AI bots that do jobs for you. So in regards to both HubSpot and Salesforce, these are going to be fairly focused on helping sales, marketing, and customer success teams to become more efficient. The fact that both of them centered their keynote speeches around AI agents wasn't entirely surprising. One of the interesting points was the way in which they did it. So HubSpot unveiled this kind of AI agent marketplace, right? Where anyone can go and create an AI agent that other people can use, right? So it's very much a kind of like indie hacker, kind of like builder approach to this new agent marketplace. Salesforce, on the other hand, spend a lot of time talking about the fact that Salesforce customers and Salesforce itself were much better positioned to be able to develop these AI agents than anyone else, right? Just based on the amount of data that they have access to in the platform, right? And so whilst HubSpot was kind of focused on their core customer base, which is like SMB and mid-market, Salesforce was a lot more focused on how enterprises can really get value from AI agents, leveraging the data that's in the Salesforce platform, right? And so I think this just again continues to highlight this divergence that we see between these two companies. They're starting to play a lot more in their own lanes, right? There's a lot of talk, especially on LinkedIn, from HubSpot enthusiasts that like HubSpot is coming to take over from Salesforce. I really don't think that's the case. What I think we'll see is just more so that Salesforce continues just to move more into the enterprise space, developing solutions for customers that HubSpot just can't service yet, right? Think about regulated industries, think about healthcare, think about more traditional industries, while HubSpot helps companies that are kind of like more agile, that are faster growing at a smaller end of the spectrum. And I think the way that they unveiled their approach to AI agents and generative AI was pretty well aligned with their strategic direction. If you haven't checked out those keynotes, I recommend doing it. I'll drop a link to both of those in the show notes. All right, Q2 SaaS metrics report is about to drop in the next couple of days. I want to give you a sneak peek of the next 3 metrics that we'll be covering in that, starting off today with ARR per employee. So ARR per employee helps us to understand the overall kind of like efficiency of a SaaS business, right? Really simple to calculate. You take the total ARR for the company and divide that by the number of employees within the business. Typically what we see is like under 300,000 for SaaS companies at scale would be considered poor. Between 300 and 400,000 is good. Anything over 400K would be considered gold standard. So when we look at this chart, there are 2 clear outliers, right? Twilio and Palantir lead the pack here pretty significantly. So Twilio is just under 800,000 per employee. Palantir just under 740,000 in ARR per employee. Rubrik, who we covered last week, is right down the bottom of this. So they're at 246,000 in ARR per employee. But as we saw last week, growing really quickly. So I expect that number to bump up over the next couple of quarters. In terms of distribution here, we can see that about 50% of the companies that we track are over the 400,000 gold standard mark, and then 15 of them are just below that. And from a change over the last 8 quarters standpoint, we can see that this number has increased pretty significantly, right? So an improvement of 28% from Q2 in 2022 to Q2 of this year. So going from 302,000 as a median up to 387,000. Right, so the reason for that is that if you think back a few quarters ago, right to the beginning of this year, a lot of companies laid off thousands of people, right? So we had this big reduction in headcount, and at the same time, right, these companies have continued to grow ARR. And so what we've seen is, the employee base has shrunk in some cases, or at least hasn't grown significantly, and then we've had an increase in ARR run rates for these businesses. So we can see that efficiency across the business is improving. Right, next we're looking at Rule of 40. We've talked about before, it's kind of another efficiency metric, right? It helps us to understand how a company is balancing kind of growth with free cash flow generation. The target for this metric is, as the name suggests, 40, right? So if you can come out with a score of 40, that's considered good. Looking at this chart, we can see that CrowdStrike blows that out of the water, so they've got a Rule of 40 of 60 at the moment. That 60 is made up of 28% in free cash flow and 32% in growth. Atlassian and Monday also had strong Rule of 40 results for Q2, so 57 and 56% respectively. Monday gets there through 34% growth and 22% free cash flow margin. Atlassian gets there 34% growth and 23% free cash flow margin. At the low end of this chart, we've got MongoDB, who comes in with a Rule of 40 of 12. That's made up of 13% growth and a negative 1% free cash flow margin. Now, the interesting thing to look at here is the composition of Rule of 40 and how that's changed. So if we go back to Q1 of 22, we can see that the median Rule of 40 was 45. Now, that was made up of only 2 points of free cash flow margin and 43 points of growth, right? You compare that to Q2 of 24, and we've got 16 points of free cash flow margin and 22% of growth, right? And so this continues on the theme that we've been talking about for the last couple of quarters, and that is that as the growth rates are slowing, companies are making the required adjustments in order to generate more free cash flow to figure out how they can run the business in a more fiscally responsible way. We can see that pretty clearly in this composition of Rule of 40 metric here. So last week we talked a lot about the fact that these public SaaS companies are having a much harder time generating top-line ARR growth. And we're seeing pretty poor performance in terms of go-to-market metrics, right? CAC payback periods are up, magic number is down. And so we wanted to take a look at, are these companies responding by reducing sales and marketing spend, right? Or are they just going to continue to spend the money in the hopes that ARR growth returns, right? Regardless of what the go-to-market metrics are telling us. And so one way to assess that is to have a look at the percentage of revenue that these businesses are allocating to the sales and marketing line item. And so when we do that, right, what we can see is that there's a pretty wide distribution here on the amount that these companies are spending on sales and marketing, right? So we've got Rubrik that we covered last week, spending north of 80% of revenue on sales and marketing, right? So they're really chasing top line growth. At the other end of the spectrum, you've got a company like Viva Systems, who's only spending 15% of revenue on sales and marketing. When we look at the medians over the last 8 quarters, we can see that there has been some reduction. So in Q2 of 22, this same basket of companies was spending about 53% of revenue on sales and marketing. In Q2 of 23, that had dropped to 47%, and Q2 of this year, it's down to 44%. All right, so we have had some reduction in the spend here. So the spend is down about 17% across the last 8 quarters. And at the same time, right, growth rates are down from a median of 43% to 22%. So we could say that, you know, these companies are making the required adjustments, but we are still seeing kind of decreasing go-to-market efficiency. So it'd be interesting to continue to monitor this over the next few quarters to see if that trend continues, or if the companies, again, start to put the foot on the gas and try to capture more market share. All right, that's it for this week. Thanks a lot for tuning in. If you have any feedback, please, I want to hear it. I want to make this as informative and entertaining for you as possible. Appreciate your support, appreciate you listening and watching. I'll see you next week. Goodbye.